Can property investment really fund your retirement? Will it be possible with the banks being more difficult lately, with it being harder to grow significant portfolios with lower capital growth? Well, that's what we're going to discuss in today's episode of the Michael Yardney podcast, as I have a long chat with my regular guest, Pete Wargent. Over 2 million Australians invest in property, and for all of you living elsewhere who subscribe to this podcast, you're probably interested in property investment as well. So we're going to have a look at how you can take control of your financial future. I'm going to explain a bit about why many investors fail. We don't know what the future is going to hold, but we're going to give you some ideas about how you can get control of your financial future by explaining the various stages of wealth creation. And we're going to talk about the strategies of debt in retirement, as well as the strategies to reduce your debt before retirement. We're even going to answer that question: are you allowed to take debt into retirement? Because a lot of people say you shouldn't. Lots of interesting thoughts that this is going to make it actually a very special show. Oh, I like all my shows. I think they're all special. But this is going to be particularly useful for you because we're going to discuss what the end game is. And that's the problem. Too many investors get involved in property without knowing exactly what the end game is. Now, let's be honest, I'm not exactly sure what the end game is going to be either, because there are going to be so many changes along the way, but we're going to put you in the position that you've got more options than you think you had. So this will be a great show, and I'm also going to share a special mentorship message from one of my early mentors to help you face your fears. So, welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
Over 2 million Australians invest in property. You're probably one of them. These investors are looking to take control of their financial future and hope that one day they're going to be able to live off the rents of their property portfolio. But is this still possible in today's more restrictive lending environment? How many properties do you need to live off your property portfolio? How do you handle the debt when you move into retirement? That's what I'm going to chat about today with leading property commentator Pete Wargent. Pete's a chartered accountant, chartered secretary, has a financial planning diploma. But what's always impressed me is that he's used his long-term approach to building businesses, investing in equities, owning properties to achieve personal financial freedom in his early 30s. And I've known him well for quite a long time now and know that he's just living the life that many would be aspiring to, enjoying living in different countries, different parts of the world at different times of the year, and giving his family some great experiences living off his investments. So who better to talk about how to fund your retirement, even though, Pete, welcome.
Pleasure, Michael. Always great to be here.
Now, I know you haven't fully retired. You keep retiring from retiring, don't you? Because you come back and do your charts, do your graphs, do your commentary. But I guess where I'm coming from is that most property investors fail. They don't get the financial freedom they're wanting. They never build a sufficiently large property portfolio to be able to live off its fruits. Why do you see that happening, Pete? What do you think's going on?
I think, well, part of it is it comes back to strategy. I think people focus maybe too much on the income from their property and not enough on building the equity. Because in the end, it's the equity, your net worth. That's what helps you to retire early. The income from residential property, rental yields, they're pretty low, especially in the capital cities. Plus, you have holding costs. So if you're going to retire just off rents, you probably need a very, very large property portfolio. Most people never get there. So it's more, I think it comes back to an understanding of how to do it. And it's really by focusing on building your wealth, your equity, and not focusing so much in the first instance on the income.
I agree with that, Pete, because sure, it's the rent return that you want in the future, but you've got to build a substantial asset base first. So in my mind, there are three phases of wealth creation. The first stage is the asset growth stage, and this requires leverage. You can't save your way to wealth, so you've got to borrow and buy income producing capital growth assets. Then the next phase is to transition to your lower loan to value ratios so that eventually you can live off your property portfolio. But Pete, we don't know what the future is going to hold, and the world has changed so much even in the last decade. The rules for superannuation potentially changed, but it didn't with the election that came on, but there were changes. There was talks about negative gearing disappearing. We don't know in the future when people are going to retire. Is there going to be a pension? Isn't there? Are people going to be able to borrow when they don't have other income coming in? We don't know what the rules are going to be. But what I do know, Pete, is that if you have a substantial asset base, you're going to have a lot of options.
Yeah, well, you beat me to it. I was going to say exactly the same thing. The thing that equity gives you is choices. And as you said, maybe if you went back 10 or 15 years ago, you might have said, well, income from fixed income sources like term deposits and bonds and so on, that would have been expected to be higher back then, and it's lower today. So some things change over time. But what never changes, if you've got a substantial equity-based and net worth, you've got all the choices in the world, all of the options that you need. So you can sell down some assets and use that money to live off. You can transition your equity into other forms of income, so annuities or the stock market. You could live off the rents from a part of your portfolio. You've got so many choices, and for some borrowers, you can even just live off the equity by borrowing against the property portfolio. So there's loads of different things you can do. But the most important thing is to build up, to have enough equity in the first instance that you've got all those choices.
Makes a lot of sense. And the reason many investors don't achieve that sufficient size equity, in my mind, Pete, is they start too late because life gets in the way. It's so long away, this retirement stage, that they live for now. They don't have that concept of delayed gratification, or they don't buy the right assets. They don't have sufficient capital growth because, as you said, they're buying income assets rather than capital growth assets. And they don't stay in the market long enough. In my mind, it takes, well, probably a minimum of 20 years. But if we're realistic, for most people, more like 30 years to become financially free through building assets through property. That's not what most people want to hear, Pete. They want to get rich tomorrow.
No, and in fact, increasingly so. So you see the popularity of the next big thing. So in the stock market, there's a lot of very speculative companies that do well through the boom, and then it ends in tears. Cryptocurrencies. So anything that promises a fast buck tends to be popular for a while. But for most people to build substantial and lasting wealth, well, it usually takes a couple of cycles. That's my experience. So you need to invest through a boom cycle, then you need to pull out some of the equity from those gains and then reinvest that equity for another cycle. And then it's usually at the end of the second cycle, you suddenly wake up one day and you've got a very large pool of equity. But it takes time. That's the thing.
Sure. Now, I remember years ago when my mother was alive, she used to say to me, when are you ever going to own anything? Because I kept buying properties, but I kept taking on more debt. And that was in my asset growth stage. I've now, over the years, I'm in my late 60s, transitioned to now having much, much lower loan to value ratios, and I've got good cash flow coming out. But I'm not planning to ever get rid of all my debt. In my mind, that's not a particularly good strategy. I have no issue with going into debt in retirement, but I think you've actually got to have a strategy around it. So it's actually the strategy right at the beginning, like you said, Peter, a strategy for the right property purchase, a strategy for asset protection, a strategy for finance, but you also need an exit strategy of how you're going to repay your debt as you retire, before you retire, or during your retirement days, Pete.
Yeah, and it's interesting you say that, because I was just in preparation for our chat today, thinking back to the strategies that I've used, and you talk about the transition to the low LVR or low to value ratio across your portfolio, and it's interesting to look back because although I've had some mortgages over the years on principal and interest, I've never really paid down all that much debt. The way that the LVR came down for me, it's just that eventually over time, as your asset base continues to grow, the LVR naturally falls towards 30 and then 25%, and then that's the way the LVR often comes down over time. So it's not necessarily by accelerating the repayments on the debt, because especially in a low interest rate environment, that's effectively only earning you maybe 4 or 5%, whereas you can often command much higher returns on your investment than that. So so look, it's different strategies for a different stage in life, but ultimately you want to bring that LVR down.
So we'll talk about how to reduce debt in just a moment. But as I was thinking this through, I figured you can't assume the banks are going to be comfortable extending you further debt unless you can prove serviceability. The rules have changed. Now, as I said at the beginning, we don't know what the rules are going to be when people are going to retire in 10, 15, 20 years' time. But in my mind, you don't need to repay all the debt, but your serviceability shouldn't be dependent on keeping interest rates low, because they may be for a while, but they may not be, or about bank serviceability. You've actually got to have debt that's at a level that's going to be manageable and not choke you financially if circumstances change, Pete.
Yes, that's right. So, I suppose that's one thing that's really changed, even over the past 5 or 6 years, is that for most borrowers now, there will be a maximum amount that they can borrow. The soft cap might be around about 6 times their total income. Now, there are still, under some circumstances, you can go higher than that, particularly if you look to banks outside the mainstream lenders. But so the old model that people used to use of pyramiding debt on top of debt, you can still do it, but it will be capped out at a certain point if you don't have income from other sources. So I guess in terms of what that means for strategy, it basically means if the amount of debt that you can carry is finite, then the assets that you choose, there's a much greater emphasis now on quality, because you can't afford to waste your serviceability on poor performing assets. So that's really what's changed. You can't just continue borrowing.
No, it hasn't actually changed. Forever. Sorry to overtweak you, Peter. It's never changed. That's what you should have always done. It's just the fact that some people were lucky and got carried away owning underperforming assets, but in a boom.
Yes, and in fact, that's one thing. I mean, I guess this must be true of every cycle, but we've certainly seen it in the last few years, is that if you bought what we call investment grade properties, in the downturn, they were hardly impacted when you look at it. Maybe a little bit, 5% of the margin maybe. But a lot of the stuff, one of the characteristics of a boom is that even the rubbish sells, and even the poorest quality assets seem to be performing well. But when the cycle turns and there's no demand for those styles of properties, the downturn can be very severe. So that's where the focus on quality really pays dividends.
Now, you know that at Metropole we've worked closely over the years. We like putting a strategy to our clients and a structure to them. And so I'd like to maybe share the strategy, the structure that we suggest to clients that they go into retirement with. And we believe they should have a mix of assets. We believe they should go into retirement with their home with no debt against it, because that's not good debt. It's not tax-deductible debt against your home. We also know that a lot of people are coming into retirement with superannuation. The baby boomers not as much as the generations following them. And we want them to have a level of superannuation that's going to bring them income in. We clearly like property portfolios to be a part of their asset structure. But I think going into retirement, they should no longer be negatively geared. And that means you're going to have a much lower loan-to-value ratio to be able to generate income. Now, it doesn't have to be a lot of income, but it does need to, at least in the early stages of retirement, be self-sufficient. It's got to cover itself so that it's not draining your cash flow, because I believe that not having any debt isn't really an optimal strategy. It's probably a little bit too conservative, and you're better off having some debt to allow your property portfolio to still keep growing. So what a lot of our clients are doing at the moment, and this is not advice, because when you and I are not, you've got more qualifications than me, but at this stage licensed to give financial advice, but some of them, if they get the right advice, are living off their superannuation, often for the first 10 to 15 years of their retirement, and it allows their property portfolio to do exactly what you said a minute ago, Pete, double in value again. And even if they're not paying off their debt as a proportion, their loan to value ratio has dropped down. And as the properties have gone up, the rent's gone up, so they're suddenly spinning off a lot of cash flow. And I know others have achieved the cash flow requirements that they've required in retirement by getting dividends from shares, or for a lot of our clients, as we're getting to the transition stage, we're recommending commercial property, which hasn't got as much growth, but definitely has got a much better cash flow and it's net cash flow. So I just thought I'd share with you how we often recommend people move into retirement. But there we've already talked about owning a home with no debt, owning a property portfolio, owning some shares, owning super. That takes time to accumulate that asset base, like we said, Pete.
Yeah, it definitely does. Now, I suppose a good thing in Australia is that the stock market, as you mentioned, is almost tailor-made for people who want extra income, because the dividend yields in Australia, they're about double the MSCI global average. So around about 4% on average in Australia plus. They can be very tax effective. So we have what's known as franked dividends, or the dividend imputation system. So if you're looking for extra income, Australia's stock market is almost tailor-made for exactly that. And of course, if you learn to manage your own money in the stock market, you can actually accelerate those returns as well by buying shares that are cheaper than average and so on. So there's plenty of other sources you can go to for income in retirement. But I guess, as you said, it does all come back to having enough equity in the first instance to have those choices.
Well, another system that people use to get a bit more income in retirement is downsizing their home. I know most baby boomers grew up with the idea that they're going to buy a home, pay it off over their working years, then when they retire, sell their home, get lots of money, move into an apartment, a townhouse, a villa unit, and have so much money left over that they can live off it. Hasn't really worked that way, has it, Pete?
No, I mean, the great rush to downsizing, I mean, I know that I do have some clients who've done it, but it hasn't been the great surge of boomers selling off their assets to move into apartments that people might have expected. But again, if you do have equity in your own home, it is another option that people have, especially if they move to a region that makes places like Southeast Queensland have always been popular for exactly that reason, because people can sell their homes in Sydney and Melbourne, maybe buy somewhere for half the price, somewhere between the Gold Coast and the Sunshine Coast, and live a sort of slower paced retirement lifestyle.
Sure. But the sea change and the tree change that was talked about hasn't come about as much, because many people want to retire, but want to retire where they currently are. They want the same hairdresser, the same doctor, the same dentist. They want to be near where their children and grandchildren are. And so they've found when they downsize, there actually isn't much change left over. Another way of having cash flow through retirement is withdrawing some funds from your super. After you're 60, you can withdraw funds tax-free, and you can either use some of those funds to live off, or you can actually pay down some non-productive debt, like the debt against your home. So that's one method, even though I think if you can keep more money in your super as long as possible, that is a good idea. But let's get back to then this transition stage, Pete. Some strategies to reduce your debt along your investment journey. You've already mentioned one, just slowly lowering your loan to value ratios by not buying as much anymore and allowing natural increase in your properties to lower your loan to value ratios. What other things can we talk about?
The loan to value ratio, I mean, if you're looking solely from property, the other things you can do, you can pay down some debt, or you can sell off some properties as you get closer to retirement. But if you're looking at the loan to value ratio across your entire portfolio, well, as you mentioned, you might have some money in the stock market, you might have some superannuation that comes into the equation. So it really depends on personal circumstances. And it comes back to, well, how much income do you actually need? That's the thing, because once you know what that golden figure is, then you can work out, well, how much equity is enough. The magic number used to be, well, take the amount of income you need in retirement, and you might need, well, let's say 20 to 25 times that amount of equity. So if you needed, let's say, $100,000 of income per annum, then you might need, say, $2.5 million of equity. So that's how people used to look at it. Now, in the low interest rate environment, that might skew that ratio a little bit, but it depends on your ability to command returns on your money. So if you're able to manage your own money, the ratio is lower. If you're going to look for very safe haven assets like annuities or fixed income, well, the ratio might be higher. So coming back to your question on lowering LVR, well, there are several different ways to do it. It will happen naturally over time. You can pay down some debt, or you can start to sell off assets as you get closer to retirement.
Right. So clearly it's not how many properties you own when you retire. I think one of the themes that keeps coming through this is don't aim at a particular number of properties, aim at owning a substantial asset base, one that is going to keep growing in value, but one that also brings income in. And that's really what's more important, not how many properties, but the size of your asset base and how hard they're working for you. One other thing I'd like to just mention, Pete, the concept of selling properties. I know there are some people out there that say buy 10 properties, sell off 5 and you'll have 5 debt-free when you retire. Doesn't work that way, because when you sell those 5 properties, you're actually having to pay capital gains tax. Plus, those 5 properties will have a level of mortgage against them as well. So it doesn't work that if you sell off a property, you get all the equity back to either live off or pay debt.
Well, no, I mean, it's not to say I'm against the idea of owning 10 properties, because I do myself, but I think the key is the quality. You know, when you look at portfolios, and I've reviewed many over the years, you often find there's something of an 80-20 rule at play, and you find that very often almost all of the good work has happened from just a handful of quality assets, and that pattern tends to repeat. So I think, as you said, the key is how much, not how many. Yeah, I think sometimes people focus too much on how many properties they own, but a lot of the cheaper, lower quality assets that they own never really do that much for them.
Interesting. Another reason why you've got to once a year treat your property portfolio like a business and sit down with somebody independent. I know you coach and mentor investors, and at Metropole, we put strategic plans together for them to actually see how's your portfolio performing. Knowing what you know now, would you buy that property again? And if they say, no, it's actually a dud, I ask them, well, why do you still own it? And they come up with all sorts of excuses. We know all that, Pete, but I think you're right. It's really important to treat your properties like a business. And if the employees in your business aren't working well, sometimes you've got to pay a redundancy package. It costs you money to get rid of them to hire a better employee, a better performing asset, a better property.
Yeah, and I think sometimes with real estate, as for some people anyway, they like to tell people how many properties they own, and it might sound good on paper to own lots of properties, but if they're not high quality assets and if they're not actually building your equity, then why are you doing it? Is it just so you can tell people at barbecues how many properties you've got? That doesn't really serve much purpose,
other than feeding your ego. Pete, it's been fun having a chat with you, as we do regularly now as a regular guest on the Michael Yardney podcast. If people want to find out more about you, read your daily blogs, get your great videos, where do they get in contact with you?
Easiest place, Pete Wargent blog, or if you want to watch some of my video content, try gonextlevelwealth.com.au.
And regularly your commentaries featured in Property Update. Thanks so much. Look forward to catching up with you again real soon, Pete.
Always a pleasure. Thanks, Michael.
In a moment, I'm going to share my mindset moment with you, a message that I learned from one of my early mentors, Jim Rowan. And now that he's passed on, I'm trying to pass on as much of his good knowledge to you through regular messages in this podcast. In fact, they're amongst my favourite segments. So I'm going to explain to you a bit about how to cope with your fears. But before I do, let's just reflect back a sec on what we were talking about with Pete Wargent. It's really, really important to plan your future if you're getting involved in property investment. And what better way to do it than sit down with somebody who's got better knowledge than you and bring your future into the present and plan the future. And that's what we do when we build a specific personalized property strategy plan for you with my team at Metropole. We help define your goals. We help see whether your goals are realistic or not. We help you understand what you can actually achieve. We help you measure your progress, see how your property portfolio is performing at the moment. And if you haven't got a property portfolio, we're going to actually help you understand what you need to do. And the real benefit is you're going to be able to grow your wealth faster and safer than the average property investor, because you're going to know crystal clear knowledge of what's necessary for the future. And as we explained, the environment's very different moving forward. So why not click on the link in the show notes or go to metropole.com.au and organise a time to have a chat with our property strategist. We've got no properties for sale, but we'll sit down and help you bring some clarity to your future, make some plans for your future with numbers and figures that will help you understand what you should do and what you shouldn't do. Metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's Mindset Moment, I'd like to share a lesson from one of my mentors, Jim Rohn. And he taught me that we're not born with courage, but neither are we born with fear. Jim Rohn said, maybe some of our fears are brought on by your own experiences, by what somebody's told you, or by what you've read. Some fears are valid, like walking alone in bad parts of town at 2 o'clock in the morning. But once you learn to avoid that situation, you won't live in fear of it. Fears, even the most basic ones, can totally destroy your ambitions, said Jim Rohn. Fears can destroy fortunes. Fear can destroy relationships. Fear, if left unchecked, can destroy our lives. Fear is one of the many enemies lurking inside us. So Jim Rohn said, let me tell you about 5 other enemies that we face from within. The first enemy that you've got to destroy before it destroys you is indifference. What a tragic disease this is. Ho-hum, let it slide. I'm just going to drift along. Jim Rohn said, here's one problem with drifting. You can't drift your way to the top of the mountain. The second enemy we face, said Jim Rohn, is indecision. Indecision is the thief of opportunity and enterprise. It'll steal your chances for a better future. Take a sword to that enemy, said Jim Rohn. The third enemy Jim described, the one inside you, is doubt. Sure, there's room for healthy skepticism. You can't believe everything, but you should also not allow doubt to take over. Many people doubt the past, doubt the future, doubt each other, doubt the government, doubt the possibilities, or doubt the opportunities. Worst of all, they doubt themselves. I'm telling you, said Jim Rohn, doubt will destroy your life and destroy your chance of success. It'll empty both your bank account and your heart. Doubt is an enemy. Go after it. Get rid of it. The fourth enemy Jim Rohn described, the fourth enemy within, he described, is worry. We've all got some worries, but don't let it conquer you. Instead, just let it alarm you. Worry can be useful. If you step out of the curb and a taxi or car or bus comes and hits you or a tram, you've got something to worry about. But you can't let worry loose like a mad dog that drives you into a small corner, said Jim Rohn. Here's what you've got to do with your worries. Drive them into a small corner. Whatever is out to get you, you go get it. Whatever's pushing on you, you push back. The fifth enemy inside you is overcaution. It's the timid approach to life. Timidity is not a virtue, it's an illness. If you let it go, it'll conquer you. Timid people don't get promoted. They don't get advanced. They don't grow. They don't become more powerful. You've got to avoid overcaution. Do battle with the enemy. Do battle with your fears. Build your courage to fight what's holding you back, what's keeping you from your goals and your dreams. Be courageous in your life and in your pursuit of things that you want, and then you're going to become the person you're going to become. Some great lessons from the master, the late Jim Rohn. Well, I hope you got some benefit from today's show. As I said right at the beginning, in my mind, this is going to be one of the pivotal shows, the important shows One of the ones you should listen to more than once. But hey, there's an easy way. You can just put your podcast app on 1.5 times speed, and I still sound reasonably sensible that way. And I think this is really, really one of those episodes that you should share with a friend. Tell some people about it, because too many people get into property without understanding their end game. So on the bottom of every podcast app, there's a share button. Just click it and pass it on to some people. Let them know about it, or just tell them about it, because just like I'm trying to help you, I'm trying to get as many people educated about financial freedom, financial literacy, to help them have a better life, the sort of life they deserve. And by the way, I always appreciate it when you leave some kind words, and that happens so regularly on the iTunes and the other podcast apps. And when I read out your review, whether it's good or bad, please leave me a review. But when I do read it out, and you email me, michael@metropole.com.au, I will gift you one of my books as a way of saying thank you, as I'm going to do for OJT35, who's from New Zealand. And thank you. Look, I know from the iTunes statistics that we get listeners from all over the world, some very small countries, and I really appreciate it. I don't take that lightly. That's why I spend so much time getting the show to the level it is for you. But anyway, OJT35 wrote, "Hi Michael, thanks for your guidance and mentorship. Your podcasts and news updates provide us with an insightful view of the property markets. Our market here in New Zealand is similar to yours, as you know, and your talks are really enjoyable and informative. Cheers." Well, thanks, and cheers to you. And I look forward to twice a week helping educate you through the Michael Yardney podcast, and in between every day. Go to propertyupdate.com.au. I'm so proud that my blog's been voted for the last 3 years in a row as the world's, not Australia's, the world's leading property blog. We've had over 1.2 million unique visitors. Over 1.2 million people have already read it this year. That's amazing. And we're keeping up the great content, propertyupdate.com.au. And I'll be back again with you real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?